$1 million is a lot of money. And that is an amount that if we manage well and know how to spread out, will be beneficial for us and efficient. Therefore, in this video, we will focus on how you can spend your first million well enough. But before anything else, welcome to the Pocket Investing channel, where the world of finance and investing is made the easiest. Number 1 is rental residence. Purchasing rental residence, in the opinion of certain investors, is one of the greatest solutions if you have $1 million to invest and are seeking flexibility as well as solid possibility returns. Real estate provides distinct methods for generating earnings and boosting your investment money. Ongoing cash flow that generates earnings and long-term home value increases that result in equity growth. Investments can be spread throughout a variety of asset types, including real estate, business, industry, and commercial. The convenience with distant real estate investing is now possible thanks to modern technology, making it a fantastic choice for buyers who reside in expensive areas. Whenever you make a real estate investment afar, you can discover inexpensive properties in regions with greater yields while delegating maintenance of the property to your local real estate company. Due to the fact that real estate may be stretched or funded, your $1 million investment will go further, possibly yield larger profits, and possibly spread out concerns. Number 2 is purchase a business. One approach to engage in a business is by purchasing a company's shares or an ETF. However, a lot of investors that have $1 million to deal with just invest in a company directly instead of going through the stock exchange broker. When done properly, purchasing a business can be among the most lucrative ways to put your money to good use. There are basically 2 methods for investing in a company. You can either purchase or build your own firm, or you can become a partner in an already established one. Creating your own company can be tougher, but it can also produce greater rewards. Since an existing company has a successful track record, investing in it carries a smaller risk. However, you'll need to possess full confidence and trust in your business associates. In either case, purchasing and funding the proper firm can increase the profits on your $1 million investment considerably beyond those of more conventional financial instruments like certificates of deposits, pensions, bonds, and stocks. Number 3 is personal loans. Online services make it very simple to do personal or peer-to-peer financing, though the risk may be substantially higher than with conventional real estate transactions. However, based on the distinct level of risk, the potential earnings from personal lending may outweigh the danger if you invest less money and don't devote a greater proportion of your personal savings to this type of lending. Personal short-term lending can be given to individuals for debt relief or home improvements, as well as to business owners in need of additional capital assets for operations such as business expansion, maintenance expenses, and real estate purchases. In comparison to typical investments like stocks and bonds, yields have the potential to be substantially greater. Personal loans, on the other hand, have become less flexible since your money is generally committed for a long period of time. Unless the loan is protected by an asset like real estate, you also face the possibility of losing your money if the lender fails. Because of this, it's an excellent idea to discuss how much money you intend to set aside for personal lending with your CFP or financial consultant. Number 4 is pensions with fixed rates. Insurance companies that offer fixed-rate pensions make the commitment to offer a fixed rate of interest on the account payments made by the policyholder. They are not based on the success of other assets and are intended to offer a fixed income source that is dependable once the payments start. Fixed pensions may be a crucial investment component of your retirement account that your financial advisor suggests. However, you'll eventually pay an insurance provider more for the lower risk. Returns are higher than what you'd get from a CD or US government bond. Before we continue, don't forget to subscribe and like this video to not miss out on upcoming videos. Number 5 is bonds. A classic diverse portfolio, according to many advisors, should contain 60% equities and 40% bonds. Buying bonds focuses primarily on asset allocation, specifically in recent times of low rates of interest. Although individuals' equities like Amazon can give development, more on that later, owning bonds is also a good way to diversify your portfolio. Bonds come in a variety of forms such as business, municipal, and financial assets. Bond prices might vary as interest rates change, but they always pay interest and are fully repaid at expiration. Bonds are frequently perceived as safe and reliable investments. But if you sell one for much less than you bought for it, or if the holder stops making payments, you could lose a lot of money. Number 6 is money market accounts and CDs. Some of the most safe methods for generating a profit while having quick access to your money are certificates of deposits and money market accounts. The annual percentage yields on certificates of deposits and money market accounts are nearly at the level of inflation, so it's unlikely that your funds will generate a profit. On the brighter side, they are an excellent way to preserve your investment while maintaining your money quite accessible and comparable to owning a savings account. Number 7 is REIT. Crowdfunding is a less reliable option to engage in real estate than Real Estate Investment Trust or REIT. REIT are established as funds that control and manage income-producing real estate, including office spaces, commercial areas, residential apartments, and single-family residence. They are widely listed on the main trading platforms. You can also concentrate on specialized asset classes with the help of some REIT, like warehouses, network infrastructure, and mobile phone tower locations. Since an REIT should invest 75% of its investment in real estate and share 90% of its net income as distributions to investors, buying shares of an REIT may be the best option to effectively owning real estate. And that ends today's video. We hope you learned something today that you can apply wherever you may be. And as always, see you on our next content.